world map, this map is in front of you. So we are doing, now today we will be doing with monetary and physical policies, and I am doing from macro point of view. Now you tell me that if in any country, if you are the government, if you are the prime minister of any country, if you are the prime minister of any country, then what will be your objectives? For at least a hypothetical case, assume that you are a prime minister of a country or you are a president of a country and you have full powers to control that, the economic growth of that country. So what will be your main, what will be your main objectives? No doubt, if you become a president or a prime minister of a country, your main objectives will be that to have a price stability in that country, to have economic growth in that country, to increase the GDP of that country, increase in per capita income, increase in personal income, and all those positive signs must be there in your country. And for that, as a prime minister, as a chief, as a governor, supposing you are a governor of Reserve Bank of India, Central Bank of India, then what are your objectives? That what should be there in your country, India? It means, as a governor of RBI, your objective should be that your inflation rate in that country should be in control. It should not be very high or it should not be less, and that there is a constant, increasing appreciation in INR, Indian rupees. So these are the objectives as a governor, and that those were the objectives as a prime minister. It means if I coincide both, the main objective is that there should be a price stability in your country with economic growth. So because of these two objectives, we have we have two tools, I will say. The first tool is named as physical policy. Every country frame a policy named as a physical policy. When I say a physical policy, it is a true picture. It is a blueprint of what are the government expenditures, what they are planning to expense this year, or what they have done the expenditure, and what is the government revenue. It means a blueprint of government expenditure and government revenue. That blueprint, that picture, that prima facie, that planning, that something which is there, that is named as physical policy. That this year we are planning to have this much infrastructure, we are planning to have seaports, we are planning to have this much for social reason, we'll be doing this expenditure, this scheme, lively scheme, all that different expenditures, that in which areas the government will be planning to do expenditure. And the objective, which I have just told you, that the objective is economic growth, price stability, the control inflation. So all that expenditures will be jotted down, and from where this revenue will be coming, how much revenue will be coming from GST, how much revenues will be coming from income tax, how much revenue will be coming from other taxes. So these are the sources of government revenues, and these are the expenditure of that government. Now this list, this policy which is there, which consists of government expenditures and government revenues, just with the objective to have economic growth, to have a price stability in the country. So that policy is named as physical policy, my dear friends. So every country frames a physical policy. On the same side, I will say, if you become, the governor of this Reserve Bank of India, you're Mr. X, governor of this country, governor of Reserve Bank of India. It means what will be your objectives as a governor? We have just discussed: to control the inflation, to control the money supply, to control the interest rates. It means if you have the control over the key indicators, if you have the control over the key indicators, that is, if you have the control over inflation, if you have a control over money supply, I think you can control you can control that economic growth of that country. So that is the main objective, that is the main content of a policy. It means how much notes should be printed, how much should be the gold reserve, what should be the repo rate, what should be the interest rate, what should be the borrowing rate, whether we should have a expansion in monetary policy, whether we should have contraction in monetary policy. It means when I say expansionary, it means whether we should increase repo rate or we should decrease repo rate. We should decrease repo rate. If we decrease repo rate, the borrowing rate will be less. When borrowing rate will be less, the citizens will be more borrowing. They will taking the loan, and when they will have loan, they will start spending it. They will have start consuming it, and ultimately the economy will flourish like anything. So this is expansionary monetary policy. Similarly, in case there is a huge flow of money in the market, so monetary policy, as per the monetary policy, that is named as contractionary monetary policy. Repo rate will be increased. When repo rate will increase, the borrowing rate will increase. When borrowing rate will increase, it is a demotivation for the public, for the citizens. They will not borrow because that borrowing cost has been increased. Ultimately, the demand will decrease. Ultimately, inflation will be in control. So we have to see, as a governor, as a head of that country, that what tools, what should be my content of that policy, and that policy is named as a monetary policy. So I will be showing you so many sites with help of which we can get an idea that what I mean by monetary policy and what I mean by physical policy. Now, physical revenue, when I will say the government revenue, I will say if government revenue is more than government expense, it is a very happy position, happy case situation when revenue is more than expenditure. I will say this type of situation is named as surplus, budget surplus. And in case government revenue is less than government expenditure, I will say it is named as budget deficit. I will say it is named as budget deficit. So there are two types of scenarios, So we will be dealing with that. So in today's lecture, I will be starting with first point, that what I mean by physical policy, because in this I will be covering learning outcome number A, physical policy. So physical policy is government's use of, where the government will use their taxation and where they will spend it. It means it is a track record of government revenue and government spending. Government revenue and government spending. So physical policy is, please note down, please prepare the class notes along with me. Physical policy is government's use of taxation and spending. I will say use of revenue, revenue and expenditure to influence the economy. It means to have economic growth, to control the key indicators of that economy. We have to do expenditure, we have to collect the tax. As a government thing, then this concept will be more clear to you. That is named as physical policy. So along with physical, we have to see the monetary policy also. As the name indicates, monetary, it is relating with money. How much should be the money supply? How much is a money multiplier? What is a basic reserve behind that? What should be the policies? What should be the repo rate? What should be the borrowing rate? What should be the inflation rate? How much should be the inflation rate? All that, something which is that policy is named as monetary policy. Monetary policy deals with determining the quantity of money supplied. How much supply should be there in the in the economy, because if supply is more, there will be negative impact. Devaluation will be there, inflation will be there, my currency will depreciate. So we have to, as a governor, I have to think it from the point of view governor. It is highly intuitive that how much money should be supplied, in the economy by the central bank in the economy. So I will say this is the main monetary policy, the basic meaning. I will say this is the basic meaning of physical policy, and this is the basic meaning of monetary policy. Physical policy is more related with government, central government, state government, and physical monetary policy is more related with central bank, with the governor of that bank. So both physical and monetary policies have the same objective, aims to achieve economic growth. Both have the aim to achieve economic growth. Both have the aim to achieve economic growth with 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 price level stability. It means both Both monetary policy and physical policy have the objective to achieve economic growth, but it should be with price level stability. So how it can be achieved, But the point is, government uses physical policy, because I have just told you that physical policy is more related to the government. Sometimes government use this physical policy for political benefits also. Mostly in the year prior to elections, if you see minutely, there will be huge free allowances, free subsidies, because they want to give the incentive to the public so that they can be happy, they can be motivated, and they can give vote in the next year. So physical policy can also be used for political reasons, for social and political reasons. So I have written that note number one. Government uses physical policies for social and political reasons as well. And I have just told you what is the meaning of a budget surplus. When in physical policy the government revenue is more than government expenditure, I will say it is a case of budget surplus. But in case of India, I will say always we have a budget deficit. I will be showing you in case of Fed Reserve. I will be showing you that also. Just wait for a minute. Budget surplus, it is a scenario where government revenue is more than government expenditure. It is, I will say, it is, I'm sorry for this is budget deficit. I have written it wrong. This is budget deficit. When expenditure is more than revenue, it is budget deficit. And when revenue is more than expense, very simple, intuitive, it is named as budget surplus. And the next point which I have written, that monetary policies can be of two types, which we will be discussing in detail in the coming lectures: expansionary monetary policy or contractionary monetary policy. When I say expansionary monetary policy, it means if there is a very normal economic growth and we want to increase that growth rate, we want to have something happening in the economy, then the governor should go for expansionary monetary policy, should decrease the repo rate. It means it will have an effect on the less borrowing rate will decrease, and ultimately there will be a high flow demand in the market. So just write down 6 point detailed. I will be discussing in the next lecture. Monetary policy could be expansionary, could be contractionary. So in expansionary, I will say that the money supply will be increased and the interest rate will be decreased. In case of contractionary monetary policy, there will be an increase in interest rate. So these are the points which to be taken into account. So let me start with first point, that what is Fed Reserve, economic data. I want to show you some data in regard to Fed Reserve, and with the help of that we can find out that what is the meaning of a physical policy. Now what physical policy contains of, or just let me firstly show you. This is the graph which tells us that in how many years there was Fed surplus and how many years there was a case of Fed deficit. Just see here, from 1917, if I start, black line is Fed, okay, blue line is Fed surplus, and black is deficit. So blue, just see blue, always we have maximum cases in that we have surplus. Just see 1993, this is a surplus. Just see here, 1999 surplus, then in 1999 surplus, and in that case, this is deficit because this is below that. Okay, and this, if my budget, if the blue line is below this, I will be having a deficit. Just see here, 2013, and in this 2015 again negative, 2016, 2017. It means we can see that whether the government spending is more or whether the government revenue is more, it can be calculated with the help of a Fed deficit or Fed surplus. Similarly, in India we can find out that what were the gross physical deficit rates. So these were the rates. Just see, in this financial year 2015, minus 4.1 was the rate. In financial year 2016, 3.9 was the physical deficit of Indian government. 2017, 3.5%. 2018, 1.2%. It means we can get an idea that deficit is decreasing. So what is deficit? Physical deficit, when expenditures are more than income. and where it relates to, it is a physical policy which tells us something about that. And now I am coming to the monetary policy. In India, we have a demonetization time in November 2016, that how much should be the money supply. So that is the main role of central bank of that country, Reserve Bank of India, in case of India, that whether demonetization should be there or not. Overnight, Indian Prime Minister Narendra Modi killed 90% of the nation's currency overnight. So this is monetary policy, and then we can say that we have physical responsibility in Budget Management Act, that this, as per this act, the inflation should be this much, should not be more than that. That will be dealing in detail in the next lecture. And last point which I want to tell you, that Reserve Bank of India gives us the monetary policy, and these are the different informations which have been given by RBI, and we can directly see from that what are the repo rates, what are the reverse repo rates, what is the what is the balance of report, outlook of growth, all inflation, prices, and different scenarios we can see from here. And this is a site where I generally spend most of my time to have a look on these. So these can be, I can have a different detailed information in that policy context, and what are the different areas in which Reserve Bank of India is giving more emphasis. Hope at least you have got an idea that what is a monetary policy and what is a physical policy. No doubt in coming lectures we'll be dealing in detail. What are the tools of that? What is meaning by money multiplier? What is the process of supplying money? How should be supplied? What are the tools of monetary policy and all that? So be happy, be jolly, be cheerful.